All right, let's talk about the new accounting standard IFRS 18. Now, if you're working at a captive finance company, I know what you might be thinking. Great, another formatting change from the standard setters. But I'm here to tell you, it's way, way bigger than that. Let's dive in. And this, right here, this quote, is the whole story. On the surface, yeah, IFRS 18 is about changing how your profit and loss statement looks. But underneath all that, it's a standard that's going to force you to completely rethink your data structures and reporting systems. So, first, the real basics. This new rule kicks in January 1st, 2027. It's replacing the old IAS 1 standard, and the main goal is to make income statements more comparable across companies. But, the devil's always in the details, and that word, standardize, is where things get really interesting for you. So why are we calling it a standard in disguise? Because, and this is the kicker, to get the new presentation right, you have to fundamentally overhaul the data that feeds it. And it all starts with 5 new categories that are absolutely mandatory. And here they are. These are the new rules of the game. Every single line of your income and expenses now has to be sorted into one of these 5 buckets: operating, investing, financing, income taxes, and discontinued operations. This structure, it's non-negotiable, and it forces a level of discipline that, let's be honest, a lot of current systems just don't have. Now, for a captive finance company, this is where the real fun begins. You might be part of a huge manufacturing group, but IFRS 18 is about to make one thing crystal clear. Your business is not their business. I mean, just look at the difference here. Your parent company, they make and sell stuff. They're worried about inventory, cost of goods sold. But you basically operate like a bank. You're providing loans, you're managing credit risk, you're raising money in capital markets. You're running on 2 totally different economic engines. And this is the absolute key takeaway. The standard demands that your classifications are based on your entity's main business activity, which is providing finance. Let me repeat that. It's at the entity level. You can't just copy and paste the P&L format from your manufacturing parent. Your operating category is going to look completely different from theirs. Okay, so this brings us to what I'm calling the classification puzzle. The new rules have some really specific and sometimes, frankly, tricky requirements for how you categorize everyday financial items. Let's walk through a couple of examples. Let's start with a big one. It's a huge deal for any finance company: the interest expense you pay on the money you borrow to fund your loan portfolio. Under IFRS 18, where do you put that cost? And this is where it gets interesting, because providing financing is your main business. IFRS 18 actually gives you a choice here. You can classify these costs under financing, or you could put them in operating if you want to show more of a net interest margin kind of view. The catch? You have to pick a lane and stay in it. You have to be consistent, which means you need systems to enforce that choice automatically. Okay, pop quiz. Let's try another one. What about the interest part of your IFRS 16 lease liability? For your corporate office. Seems like an operating cost, right? Pretty straightforward? Nope. IFRS 18 is crystal clear here. Interest on lease liabilities goes into the financing category. Period. There's no choice. So what does that actually mean for you? Well, for a lot of companies who used to bury this in SG&A, it means your reported operating profit is going to go up, just from this reclassification. And hey, another thing that's getting cleaned up: foreign exchange. You can't just lump all your FX gains and losses together anymore. No more of that. Now, the classification has to follow the source of the transaction. FX on your funding debt? That goes to financing. FX on a payable to a vendor? That's operating. It forces a much, much deeper level of analysis for every single transaction. All these new, specific rules lead to one of the biggest practical changes in this new standard. It's, well, the end of an era for one of our favorite, if kind of messy, accounting practices. That's right. The other income and expense category, that super convenient catch-all bucket for all the miscellaneous stuff, it's effectively gone. You can't use it as a dumping ground anymore. So this is your new world. Every single item that used to just live in other, things like gains from remarketing or those FX impacts on debt, now has to be pulled out, analyzed for what it really is, and rigorously reclassified into a core category. Bottom line, everything needs a home now. There is no escape. Look, with all this new complexity, trying to manage this manually in spreadsheets it's a recipe for disaster. It won't work. The only sustainable path forward is automation. You have to build a proper reporting engine.
And in practice, this is what it starts to look like. You need to enrich your chart of accounts or some kind of mapping layer with new data attributes. Think about adding a new tag for the IFRS 18 category, and maybe another flag to identify transactions that are part of your main financing business. This is the data foundation for all your automation.
And please don't think you can wait until 2026 to get started on this. If you're thinking, oh, 2027 is years away, you need to rethink that like right now. 2027 is the first mandatory year, sure, but that means 2026 is your official comparative year, and it has to be fully restated. And to do that right, you're going to need clean data from 2025 for your trends and analysis. The time to start building is literally now. And one more thing, your automation has to be smart. It needs to be flexible enough to produce the correct IFRS 18 view for your local entity as a financial services company, and also be able to generate a potentially different group-aligned view for your parent company's consolidation. You need one source of truth that can speak two different languages. Okay, I get it. This probably sounds like a massive headache. And yeah, it is a lot of work. But what if we flip the script on this? What if we stop looking at it as a compliance burden and instead see it as a strategic catalyst?
I love this phrase, forcing function. It's a trigger that forces you to make improvements you've probably been wanting to make for years anyway. IFRS 18 forces you to do that data cleanup. It forces you to get rid of those ambiguous other accounts and build a clean, scalable, automated pipeline from your trial balance all the way to your final financial statements.
You see, when you get this right, it's not just about ticking a box for a new rule. This is a permanent upgrade to your finance team's capabilities. It's about building a better, clearer, and much more efficient way to tell your company's financial story to everyone, investors, lenders, and even your own management team. So, I'll leave you with this question to take back to your teams. Are you treating IFRS 18 as just another compliance task to get through? Or are you seeing it for what it really is, the strategic upgrade it can be? This is a genuine opportunity to invest in your data and automation that will pay off for years to come. The choice is yours. Thanks for joining me for this explainer.